Right. Good morning, everyone. This is Marshall Gittler bringing you the morning comment for July 31st. It looks to me like everything is coming together to support the dollar. The data yesterday from Japan, Europe, and the U.S. all agreed. Now let's go right to the U.S. data, which was the most important for the market. The ADP employment report was lower than expected, but employment growth, job growth remains over 200,000 a month, so it shows the labor market is still improving. Then come the GDP figures. Not only was the second quarter GDP far above estimates, but also for the first quarter and all of the second half of last year were revised up as well. On top of which, the second quarter core personal consumption expenditure deflator grew at 2% at an annualized basis, meaning the FOMC has hit one of its two targets. The better economy and higher inflation were both reflected in the FOMC statement later in the day. There were no significant changes in the FOMC's policy guidance, but from my point of view, the tone of the statement was slightly more hawkish, in line with the improvements in the economy. The committee noted that inflation is moving towards their target and said that labor conditions had improved. But on the other hand, they emphasized that some other indicators besides the unemployment rate show continuing slack in the jobs market. Now, the FX market focused on that point and interpreted the statement as dovish, which I think is a misinterpretation. It looks to me as if the committee is just trying to play down the improvement in the unemployment rate and instead focus on some other labor market indicators that still show a difficult labor market to enable them to keep their flexibility about the timing of a rate hike. I think the FOMC will finish tapering off its bond purchases as scheduled in October. Moreover, if the next several labor and inflation reports continue to improve at their current pace, we could see soon some more concrete indications of when they'll begin raising rates. I think the market will have to move closer to the FOMC's way of thinking, and that this change in market view will support the dollar. As for the FX market, some currencies are starting to trend. Eurodollar may finally be starting to show the effects of the divergence in monetary policy between the ECB and the Fed. Now, as for the indicators today, the Eurozone CPI for July is expected to remain at June's 0.5% year-on-year. Now, yesterday's German CPI had only limited impact on the euro, so I think the Eurozone CPI will also just have a limited impact if it's within estimates. Canadian GDP for May is expected to have accelerated from April. That could cause some profit-taking in dollar Canada, which has risen recently. In the U.S., the Chicago PMI index for July is forecast to have increased slightly. On the other hand, initial jobless claims are also forecast to have increased a bit. These figures aren't dramatically better, but as long as they're not dramatically worse, they shouldn't derail the dollar from its upward trajectory, in my view. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, head of Global FX Strategy at IronFX Global, wishing you solid trading.